We begin our report with the abrupt closures of 3 banks in a matter of days that are now sending shockwaves across sectors of the economy and raising concerns about the U.S. banking system.
Former parent company of Silicon Valley Bank is now filing for Chapter 11 bankruptcy.
SVB Financial is now separate from the bank following its takeover by the FDIC.
More growing concerns, these about the banking industry. Stocks falling despite a rescue package for First Republic Bank as the former parent company of collapsed Silicon Valley Bank files for bankruptcy protection.
Have you ever wondered what the Federal Reserve fears more than inflation? Well, in this video, we have some leaked information that might just surprise you. If the government hadn't stepped in to reassure depositors that their money was safe, over 40,000 small businesses might have gone under, threatening the jobs of over 100,000 people. SVB's clientele largely consisted of younger, more experimental businesses. Companies like BlockFi, one of the largest cryptocurrency companies, which had over $227 billion in SVB despite having barely any profit margins. Since 2022, the value of cryptocurrencies has fallen, leaving many cryptocurrency-related businesses unable to operate without exhausting all available resources. One such company was Circle, which had over $3.3 billion in SVB, which was, essentially, all the money the company had. How, though, did a bank with $220 billion in assets fail? In what universe does that exist? What happened at SVB was deliberate. The SVB's demise was predictable by anyone with even a cursory knowledge of economics and the market. The real story begins in the 1970s, when pioneering Silicon Valley firms like Apple and Oracle were established. As a result, Silicon Valley was recognized as a center of technological innovation and talent attraction in the 1980s. The only drawback was that these companies did not generate revenue in the conventional sense.
We're talking about everybody from some of the large investors to the little guy. I'll give you some examples. There was one CEO and founder of a tech company based in Australia who spent hours inside this building, the company's headquarters today, and left upset at the fact that while the bank was assuring him, or at least the FDIC regulators who are now running this bank, that he would have access to his millions and in some cases tens of millions of dollars companies have in this bank, he was upset that he had to still jump through a number of technical hurdles in order to have access to that money to fund his payroll. And then when we speak about the little guy, we spoke with one gentleman who is of retirement age but is still working as an accountant who had his life savings, John, all of his life savings tied up here. He shared with CBS that he was given 2 options to access that money. He could withdraw it as a cashier's check, or he could withdraw it as cash. And while he didn't want to disclose which option he took, he had experiencing such anxiety since last week when this bank failed, not knowing if his entire life savings were lost. He is furious at the leadership of this bank. He does believe that there should be harsh penalties for the CEO and others who knew that their long-term treasury bonds were becoming less valuable as they knew that when customers would come for their money, it wouldn't be available. And so while they did see hundreds of people, and we witnessed them, the bank just closed here about an hour ago, which is why you don't see customers right now. Many customers left this location today upset at how long it will take to really get their hands onto their cash.
And quickly, Errol, fury often turns into lawsuits. What can you tell us about lawsuits filed against the bank?
Well, this afternoon, 2 major announcements, one from the Federal Reserve Board itself. They have appointed someone who will oversee the regulation of this bank. There was also a lawsuit filed by one of the shareholders suing the group that owns the bank and the CEO himself for concealing the risk their approach on investments, those long-term bonds, exposed to clients. That could become a much larger class action suit in the days ahead. So certainly the story not finished here.
Why did SVB fail?
It made bad choices. Regulators let it make bad choices. And it, as the youth say, it effed around and it found out. The long story short is that the Silicon Valley Bank had a lot of money from startups. It was holding on to a lot of money, didn't quite know what to do with it, plowed a lot of that money into these very long-term investments, safe investments, but very long-term investments. And then the Fed started raising interest rates last year, and Silicon Valley Bank got caught out. It had all these investments that weren't looking so good anymore. Earlier this week, last week, people in Silicon Valley decided we need to get our money out, and a bank run happened.
Jeff, okay, I'm just going to ask an ignorant question. You could see rate rises coming from the Fed from space. They've been coming for a long time. They are the least surprising thing in the economy. So why is these long time rates have been raising for a long time? So why did this create this panic spike last week?
John, you are absolutely right. And in fact, the Wall Street Journal had an article last November pointing out that Silicon Valley Bank and banks like it were dealing with a lot of risk in their portfolios because of these rising interest rates. And the answer to that question is that a bank can sort of stagger along for a really long time with these headwinds, but sometimes some coordinating event happens and people decide, oh crap, we need to get our money out. And when that starts to happen, when the panic starts to set in, there's nothing that can save a bank except the government stepping in to fix things.
Right. Banks are based on confidence, and when confidence is lost, whoop, there goes the bank. So the regulators or the government agencies are stepping in to protect some depositors. Other people are not being protected. Sort that out for us. Who's got a chance of holding on to their money and whose money is gone?
Well, I just want to say this is the first time we've seen a bank run in the age of group texts and social media, and so when this stuff happens, it happens real fast, right? What the Fed announced today, I believe, is that everybody at Silicon Valley Bank is going to be fine. People were worried that, officially the FDIC limit for insurance is $250,000. So people with more than that in this bank, which a lot of big companies had more than $250,000, they were worried that they were going to lose their money. But the Fed stepped in and said, everybody's going to be fine. We're going to guarantee everybody's deposits. We're going to take it out of the same FDIC fund. So technically banks pay into that fund. So in theory, no taxpayer money is going to directly fund these deposits or backstopping these deposits. But in theory, everybody should be fine. But the investors of the bank are going to lose. They're going to take the losses, as they should.
And let me just underscore that super quickly. The depositors who weren't monkeying around with anything, they're fine. It's the investors, shareholders, they will not be made fine.
They will not be made fine.
What are your thoughts on the information we shared about the Federal Reserve's concerns? Do you think this will have a significant impact on the economy? Let us know in the comments below. And as always, don't forget to like, share, and subscribe for more insights into the world of finance and investing.